Welcome back to Smart Stock Sam, the channel where we cut through the noise, follow the real data, and help you think like a serious investor. If this is your first time here, hit that subscribe button right now, because today's breakdown is exactly the kind of deep dive we live for. The CEO of SoFi Technologies, Anthony Noto, just went out and bought even more shares of his own company, with his own money, at current market prices. What does the man running the company know that the rest of the market seems to be ignoring? That is the question we are going to answer today. We are going to rip apart the fundamentals, decode the technicals, expose the real risks, and by the end of this video, you are going to have a crystal clear picture of exactly what SoFi is, what it is worth, and whether this moment is a gift or a trap. Let us start with the most jarring reality of this entire story, because it genuinely sounds like a riddle. How does a company report its best quarter in history and still watch the stock crater? SoFi just delivered its 10th consecutive profitable quarter, 10 straight. In a world where most fintechs are still burning cash, trying to find a path to GAAP profitability, SoFi has quietly built what looks like a sustainable, real money-making machine. And yet the stock is sitting near multi-year lows. The phrase "broken stock, not a broken company" gets thrown around loosely in finance, but rarely does it fit as perfectly as it does right here, right now. So let us look at the actual numbers, because the contrast between the operational reality and the market pricing is almost shocking when you see them side by side. On the business side, SoFi just reported $1.1 billion in adjusted net revenue for the first quarter of 2026 alone. $1.1 billion. That represents a 41% year-over-year growth rate. For a company of this size, that is not just impressive, that is extraordinary. On the market side, the stock closed at $15.75, which means it is down 40% year-to-date and sitting more than 50% below its 2025 highs. Normally, when revenue grows by 41%, you expect the stock to at least follow the trend line in some direction. Instead, the price is moving in the exact opposite direction. So something is clearly broken. The question is whether it is the business or the market's perception of it. To understand why the market is behaving this way, you have to understand the four major headwinds that are currently overriding every single positive number on the spreadsheet. The first is what I am calling guidance stagnation. Despite absolutely blowing past first quarter estimates, management chose not to raise their full-year outlook. And here's the thing. In a high expectations market, standing still is perceived as falling behind. Investors were hoping for a reward after a blowout quarter, and instead they got silence. That silence felt like a warning sign, even if it wasn't one. The second headwind is the macro trap. SoFi originally modeled its full-year plan around 2 Federal Reserve rate cuts. We are now looking at 0 cuts this year. That is not a small revision. That fundamentally changes the economics of lending. It forces SoFi's management to execute with near perfection in a higher for longer rate environment, and the market is pricing in the possibility that they simply cannot do it. Third, there is the short seller noise. Muddy Waters released a report alleging unrecorded debt on SoFi's balance sheet. SoFi pushed back hard and contested the claims, but in markets, perception is everything, and the report left a smell in the room that spooked institutional money. And fourth, the Chime exit. The departure of Chime from SoFi's technology platform caused a 27% drop in tech platform revenue. And this one matters a lot, because the tech platform was supposed to be SoFi's high-margin growth engine. Investors are now asking a very uncomfortable question. Is that engine stalling before it even reaches full speed? Now here is where it gets interesting, and this is the part the bears tend to ignore entirely. There is one metric that CEO Anthony Noto keeps coming back to, and it actually suggests SoFi should not even be valued like a bank. It is called the Rule of 40. In the software world, if your revenue growth rate plus your profit margin exceeds 40%, you are considered elite. So, Fi right now is sporting a score of 72. 41% revenue growth, plus 31% EBITDA margins. That puts them in the company of the highest performing software businesses on the planet. The bull case is essentially this: the market is capping their valuation based on banking sector risk multiples while completely ignoring that they are operating with tech sector efficiency. If that re-rating ever happens, if the market finally prices SoFi like the software platform it is becoming, the upside is genuinely asymmetric. But a strong Rule of 40 score doesn't mean much if the underlying business quality is eroding beneath the surface. So let us look at 3 numbers that reveal what is actually happening inside the company. First, 43% of new products in the quarter were taken by existing members. This is massive. It means SoFi is spending less to acquire customers and making more from the ones it already has. That is the definition of compounding unit economics. Second, the net charge-off rate came in at 3.03%. Despite all the fear around a consumer credit collapse, SoFi's borrowers are holding up, which validates the high-quality borrower thesis that management has been pushing for years. These are not subprime borrowers. These are graduates, professionals, and high earners, and they are paying their loans. But here is the curiosity gap. Look at the crypto unit. $121 million in volume, but only $852,000 kept as margin. That is razor thin. It is a speculative lane that is not moving the needle yet. High volume, negligible profit. It is worth watching, but it is definitely not a reason to get excited right now. Okay, so the fundamentals are a fascinating mix of incredible and work in progress. But then you look at the technical charts, and if you are a chart trader, this is genuinely painful. The stock is trapped in what analysts are calling a strong sell consensus. A death cross formed back in March. That is when the 50-day moving average crossed below the 200-day, and the stock has not recovered since. We are sitting significantly below all major moving averages: the 20-day, the 50-day, and the 200-day. That confirms entrenched bearish momentum. For this stock to move higher, it does not just need good news. It needs to break the gravitational pull of those descending lines. And right now, the path of least resistance is still pointing down. But even inside a downtrend, early signals can tell you when the bleeding is starting to slow. On the 4-hour chart, there is actually a glimmer of hope worth paying attention to. The price action is compressing into what technical traders call a falling wedge pattern. This structure is often, not always, but often, a precursor to a bullish reversal. The stock is also testing the 0.236 Fibonacci retracement level at $16.20. But the most interesting detail, the RSI divergence. While the stock price was making lower lows, the relative strength index started making higher lows. This divergence typically suggests that selling pressure is exhausting itself. We are approaching oversold territory, which historically has been the zone where patient buyers start stepping back in. Is a bounce guaranteed? Absolutely not. But the conditions for one are beginning to align. Now, for a real bounce to ignite, you need to understand the short interest picture, because the short sellers have a lot to say about what happens next. Right now, 12.54% of the float is sold short. That is over 158 million shares betting against SoFi, significant by any measure. But here is the catch. The days to cover figure is only 3.04. That means the bears could exit their entire position in just 3 days of normal trading volume. For a violent short squeeze to happen, the kind that sends a stock up 30% overnight, you would need a massive, unforeseen catalyst, something like a surprise mega partnership announcement or a shock guidance hike, something that forces every single short seller to cover at the same time. Could that happen? It is possible, but until that catalyst appears, the shorts are sitting comfortably and they are not scared. Here is what is interesting though. While the short sellers are comfortable, the options market is telling a completely different story. Looking at the options chain for the May 15th expiry, we are seeing a 68% tilt toward call options. The biggest concentration of bullish bets sits at the $20 strike price, with over 121,000 contracts of open interest. On the other side, the floor of bearish protection is clearly stacked at $15. What this tells you is that sophisticated players, the ones trading in size, see $15 as the psychological downside support and $20 as the near-term ceiling. If the stock holds above 15, the options market is effectively signaling that the path to 20 is wide open. This is classic dip buying behavior from people who have done their homework. And speaking of people who have done their homework, let us follow the money at the very top. CEO Anthony Noto has been buying his own stock like it is going out of style. He just picked up another 15,878 shares at an average price of $15.73 on May 8th. Before that, he dropped $500,000 of his own money right after the Muddy Waters short seller report dropped in March. You do not do that if you think your company is broken. That is a high conviction signal from the person who has the most information about what is actually happening inside the business. On the institutional side, it is a tug of war. UBS increased its position by a staggering 136% in the first quarter. JP Morgan added 17 million shares. Meanwhile, Mitsubishi and Highland Capital are trimming their positions. The big banks are essentially reshuffling the deck. But the core leadership, they are doubling down at current prices. So what does Wall Street officially think? Honestly, they are completely divided. The consensus is a hold rating, but the price targets range from $16 all the way to $30. Morgan Stanley is sitting at $16, basically telling you the stock is dead money. Citigroup and Mizuho are at $30 and $29 respectively, implying nearly double from here. A 100% gap between the bearish and bullish targets. When you see that kind of spread among professional analysts, it means the market genuinely does not know how to value a company in the middle of a transformation from a digital lender to a full-stack financial technology platform. And that uncertainty is exactly what creates the volatility and the opportunity. So after weighing all of this, the record profits against the brutal charts, the divided analysts, the insider buying, the short interest, here is the bottom line. SoFi is offering what I would call a favorable risk-reward asymmetry. The sell-off from the 2025 highs looks like it has already priced in the lack of rate cuts, the chime departure, the Muddy Waters noise, and the guidance stagnation. By dropping to $15.75, the market has cleansed the over-optimism of last year. The technicals are screaming sell. The fundamentals are screaming buy. And historically, this is exactly where the most asymmetric returns get generated. Not when everything is obvious, when it is confusing. Now let us get specific about the actual trade setup. For a Tier 1 entry, the accumulation zone is between $15.75 and $16.10. This is where the floor appears to be forming. If you want more confirmation before committing, a Tier 2 entry would be a long position above $16.50, which would signal a breakout from that falling wedge structure. Your must-hold support level is $15 even. That is the psychological line and the options-heavy boundary. If the stock loses $15, the next stop is the 52-week low at $12.74. So watch that level with absolute discipline. On the upside, the short-term target is $18.12, which aligns with the 0.618 Fibonacci level. If the stock can clear the moving average resistance at $17.50, the momentum should carry it to the medium-term target of $22, right in line with the Wall Street consensus. For risk management, a strict stop-loss exit below $15.38 is the play here. Volatility will be extreme during this price discovery period, and protection is non-negotiable. SoFi is the textbook case of a company that is outperforming its own stock. The data says the business is winning. The chart says the stock is losing. At some point, those two lines have to meet. They always do. Before I wrap up, one important note. Nothing in this video is financial advice. I am not a licensed financial advisor, and everything here is for educational and informational purposes only. All investing involves risk. including the potential loss of principal. Always do your own research. Consult with a qualified financial professional before making any investment decisions, and never invest more than you can afford to lose. Now here is where I want to hear from you. SoFi is sitting at a crossroads that most stocks never reach. 10 consecutive profitable quarters, a CEO buying shares with his own money at the lows, and a stock still cut in half. So here is my question for the comments. Do you think Anthony Noto's insider buying is a green light signal? Or do you think even he could be wrong about his own company's timing? Drop your honest take below. I read every single comment. If this breakdown gave you a new perspective, hit the like button right now. It genuinely helps this channel reach more investors trying to cut through the noise. If you are not subscribed yet, hit subscribe and ring that bell so you never miss a breakdown like this one. And if Smart Stock Sam has ever helped you think differently about a trade, consider sending super thanks. Every dollar of support goes directly into making deeper, sharper research for this community. Take care, and I will see you in the next one.